All right, so welcome back. So in this training, you're going to learn about annuities. Now we're going to dive deep into annuities because here's the thing. Annuities is one of the most difficult parts of the life insurance exam. Most students who fail actually perform poorly on the annuities section of the life insurance exam. So this is a very long training. So we're going to divide it into multiple parts, okay? So strap yourself in. Make sure you have a pen and paper or your notebook to take notes. Watch the entire thing from beginning to end. If you're listening on the podcast, you want to listen to the entire thing from beginning to end. So see you in the training. So here, this is the live producer from Maryland. So now we finish section 6.1. So all those questions, those 10 questions, they cover accumulation period versus annuity period. It covers the definition of owner, annuity, and beneficiary. It covers insurance aspects of annuity, and it covers suitability. So those 4 topics were covered under 6.1. So now we'll move to 6.2. So 6.2 now we'll look at immediate versus deferred annuity. We'll look at like the single premium immediate annuity. We'll look at non-forfeiture, premium payments, surrender charges, dollar provisions, all of that stuff. So let's go. It looks like we'll probably not finish 6.2, but we'll come next week. Then we'll continue. Annuities is a little long. You see, like compared to qualified retirement plans. Qualified retirement plans is pretty short, right? So we're going to spend some time on annuities. But if you can do well in annuities, because this is what really gives people problem. If you can do very well in annuity, then you stand a very good chance of passing your exam. Because some students will score 30% on the annuity session. Some will score even as low as 20%. So this really brings people's score down. So if you can score 90% or more on this, then you increase your chance of passing your exam. All right. So let's come here to our questions. All right. Let's go here to 6.2. All right. So 6.2, a single premium immediate annuity. So on your exam, sometimes they won't type all of this out to say single premium immediate annuity. They may just say SPRA. Just know that when you see SPRA, it means single premium immediate annuity, or you may see SPDA, single premium deferred annuity. So just know that abbreviation. Okay. So a single premium immediate annuity begins payments well, you got this one right? Immediately within 12 months. So it seems like you know this one, which is good. Then B says only after 10 years. No, false. We say within 12. If it's immediate, it's within 12 months, right? C says at annuitant's age 65. No, that's wrong. D, after the accumulation period has ended regardless of time. We said that's wrong also. So let's come here to the answer. You can read the answer for number 1, please. Okay, you can read the answers for number 1.
A single premium immediate annuity begins payments right away, typically within 12 months of purchase. Deferred annuities is contract postpone payment until a late date. Option B, C suggests fixed age or time frames, which are incorrect.
Exactly. So that one is straightforward. Any questions on that one?
Little explication, sir. Maybe a little explanation about that. I think I know that we went through it, but
okay, no. So single premium, again, single premium immediate annuity. It just means that you're paying your annuity with just one premium, right? So anytime you see single premium, it means you're paying your annuity with just one premium instead of paying it every month. Like, for example, if you win the lottery, if you win a lawsuit, you win a divorce. I always talk about my client who won a $6 million divorce settlement, right? So she bought a single premium, but that was deferred annuity. And then you have inheritance. So when you inherit a lot of money, you can use it to just buy a single premium. So most people who do annuities will get they'll get multiple premium annuities because very few people have that kind of money to just pay one time, right? But again, the key to remember is that it's within 12 months. If you start receiving your benefits within 12 months, it's immediate. If it's more than 12 months, it's deferred. So on your exam, they even say 30 days. It doesn't matter. It's within 12 months, it's immediate. Yeah.
Here they use a different approach. They did not put they did not even put immediate, but they use single premium immediate. Yeah, they use immediate. It's okay. Yeah.
You got it? All right. So
Yeah,
that's
that is fine.
to question number 2. Okay, question number 2 says, which feature distinguishes a deferred annuity from an immediate annuity? So we'll start from the bottom, go up. So D says deferred annuities are only sold to retirement plans. That is false, right? You can sell deferred annuities to anyone. You can sell it to individuals. It doesn't have to be only retirement plans, right? So that is false. C says deferred annuities guarantee higher payout amounts. Not really. There's no guarantee. Just because you get a deferred annuity doesn't mean you're going to pay, you're going to get higher amounts, right? So it has no impact on the amount you get. A says deferred annuities require multiple premium payments. No, 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 no. You can have single premium deferred annuity where you just pay one premium, but instead of receiving your benefit within 12 months, like I gave the example of my client who won that $6 million annuity, and she was young in her 30s.
They refuse to take
So
him
she
now.
said, I don't need this money now, so I'll get a single premium deferred annuity, and I'll start getting my benefits when I'm in my 50s, right? So that's, even though it's single premium, but it's deferred. This is saying deferred annuities require multiple premium payments. No, you can either pay one premium or you can pay multiple, but it doesn't require. So we know that A is wrong. B says deferred annuities have an accumulation period before payouts begin. Deferred annuities have an accumulation period. That is correct, right? Because what is accumulation period? Accumulation period means that you're not receiving money. So the easiest way to remember this is the accumulation period is anytime the period where you're not receiving money or you're not receiving income is accumulation. Because when you're not receiving money, then your money is growing, right? If you're not receiving money, your money is growing, right? So when your money is growing, it's accumulating. So deferred annuities have an accumulation period. Why? Because they have at least 12 months. Whereas immediate annuity is immediate. Sometimes you make an annuity payment today. Now you open your annuity account today, and then 2 weeks later, you start to get benefit payments, right? So, but deferred annuities, you have to wait at least 12 months. So it has an accumulation period. Any questions?
Did you know?
Is that 98% of our students pass their life insurance exam. Do you know what the national pass rate is? 50%. So no matter how many times you failed your life insurance exam, no matter how old you are, no matter which part of the country you are from, we can help you pass your life insurance exam. So if you want to pass your life insurance exam without stressing, then enroll in one of our online memberships or book a free one-on-one consultation for more information. Now let's get back to our training.
So I wanted to ask this question, which is they're talking about the fair accumulation period. Oh, question don't see it nice.
No, it's okay. I mean, you can ask. Yeah, what's the question?
I'll ask later, sir.
You sure?
I have the question in my head here, but it just
not a problem. You can ask anytime you remember.
Okay, it came up. It came.
Okay.
So I wanted to ask, during the amortization period, the money that they are giving you, is it your interest or is your premium pay that you are getting half?
It's both. So the payment you get will be a mixture of both annuity, what you put in, and what you the interest. Yeah.
Because you just mentioned that if you get to pay out, like your client, she put the money in and then she said that she want to receive it at the age of 50. But now her interest is growing. But if she was finished, maybe she finished her accumulation period and then she start taking the money, it means that the money is not growing as it's going as she's taking out.
No, your money. So when you start taking your money can still be okay. Let me repeat this. During the accumulation period, your money is growing interest, right? During the annuity period, your money can also be growing interest because your money is sitting out. Let's say you're getting an annuity for life, right? You can be getting money and your money can still be growing. So remember, the insurance company, and I hope this is not confusing. I'm trying to find a way to break it down. when you have an annuity, the insurance company guarantees you a payment for life, right? Whether it's $500 a month for life and stuff. The insurance company is not just going to take, let's say you have 10 million, they won't just take that 10 million and just take a bowl and just wrap it up and put it down and say, okay, no, because there's something called inflation, right? So if your money is not growing, it's decreasing with inflation.
Decreasing.
So what the insurance company will do, they'll take some of your money, even during the annuity phase, they'll take some of that money and invest it so it can be growing interest, right? So during annuity phase, your money is still growing, right? But it will be some, not all. Again, it's complicated. The insurance exam will not get into that. When you become an agent, then maybe you can get, but for the exam purposes, you don't have to worry about that technicality.
Okay.
Yeah. All right. So we said correct answer was B. Deferred annuities have accumulation period before payouts begin. Again, for those of you watching, the blue are the answers she selected. Green are the correct answers, and anything in yellow and blue means that she got it right. She got that question right. Okay. All right. So let's come here to B. Can you read B, please?
The key difference is that deferred annuity has an accumulation period, while immediate annuity start paying soon after purchase. Deferred annuity can use single or flexible premium, not just multiple payment. Option C is misleading. Payout depend on rate and funding.
So it depends on the interest rate and how much is
and funding.
Right? Okay. All right, let's go to question 3. All right. Okay, we have about 15 more minutes. All right. So we'll do maybe 1 or 2 more questions, and then I'll go over your assignment for next week. Okay. So question 3 says, which is true about premium payment options in deferred annuities? Again, which is true about premium payments in deferred annuities? A, they must always be paid in one lump sum. That's false, right? Because deferred annuities, you can choose to do multiple premium payments. We call that periodic premium payments. So every month or every 3 months. So it doesn't have to be one lump sum. So we say A is incorrect. C says they must be level annual payments. No, you can choose to pay monthly. You can choose to pay every 3 months. It doesn't have to be. Annual means every year, right? Once a year. No. So that's wrong. D says they cannot exceed 5,000 annually. No, that's wrong. No, again, it depends on, you can have your annuity as big as, you can even pay 5,000 a month. It depends on how much money you have. Like, I've seen people pay 15,000 a month, like very rich people pay 15,000 a month for their annuity, right? So there's no minimum maximum. It just depends on how much you can afford. So correct answer is B. They may be single premium or flexible premium. Again, flexible premium means you're paying more than once, and then your premium doesn't have to be fixed. All right, so let's come here, read the answer for this, please. All right, so number 3, you can read that, please.
Yeah, deferred annuities may be purchased as a single premium deferred annuity, SPDA, simple premium deferred annuity, or a flexible premium deferred annuity, which is FPDA, flexible premium deferred annuity. They do not require only annual or level payment. This flexibility is one reason annuity are common in retirement planning.
Okay, so flexible premiums mean that your premium payments vary. Like this month I can only afford to pay $500. Next month maybe I can afford to pay $100. So your premium payment is not fixed, right? Again, at the end of the day, when it comes to annuitize, the total amount you have in there, they'll determine that. So there's not like, so if you choose flexible premium, then your payments can be flexible. You can pay $50 this month. Next month you pay $500. It just depends. So again, that's why it's called flexible. All right. Any questions on that?
No, sir.
Okay, so you got that one right. All right, let's go to question 4, and then we'll end with question 4, and I'll tell you what they're planning for next week. Okay, so question number 4. All right, so question number 4 says, which statement is correct about non-forfeiture provisions in annuities? Non-forfeiture. Again, when you hear the word forfeit, means to lose, right? Forfeit means to lose. So when it's non-forfeiture, that means not to lose, right? So which statement is true about provisions that they put in place for you not to lose your annuities, right? Because at the end of the day, the state insurance department wants to protect consumers. And it says that if you put money into your annuity, you should have some minimum guarantees where you're not just going to put your money in and you lose everything, right? So you should have some minimum guarantees. So those minimum guarantees are called non-forfeiture because they don't want you to lose everything. So now this is what it is. So now let's start from the bottom up. D says the guarantee annual, no, the guarantee annuity payments cannot fluctuate. No, that's wrong, right? Non-forfeiture, it depends on which option you select, right? But for example, if it's a variable annuity, then your annuity payments can fluctuate. You can get 500 this month, next month you get 1,000, the following month you get 100, right? So it just the guarantee annuity payments cannot fluctuate. No, it depends. Your annuity payments can fluctuate based on the type of annuity you have. So D is incorrect. C says they prevent insurers from charging surrender penalties. No, by law, the insurance companies can charge you surrender penalties. What is surrender penalties? Surrender penalties means the penalty you get for canceling your policy. Right? So if you cancel your annuity policy early, most companies will give you like 10 years surrender period. So that means if you cancel your policy within the first 10 years, then the insurance company will charge you a penalty fee, maybe 5%, 10% of your that. So that is legal as long as they let you know in your contract value, in your contract ahead of time, like, hey, these are our surrender fees. If you cancel the policy early, these are the fees we'll charge you. That's fine. So companies are allowed to charge surrender penalties. So there is nothing illegal about that, right? Then A says the guarantee that the annuitant can always withdraw. Again, I've always told you, anytime you see the word always, watch out. Always, most of the time, is wrong. So the guarantee that the annuitant can always withdraw at least the full account value. No, they cannot guarantee that always because, as I said, variable annuities, we'll get to variable annuities. Where will we get to variable annuities? Variable annuities. Okay, yeah, 6.4. We'll get to variable annuities in 6.4, right? But but for that, if it's a variable annuity, there's no guarantee because you may lose all your money in a variable annuity account, right? Because it's like investing in the stock market. You can make a lot of money, you can lose all your money, right? So variable. So this is saying that the guarantee that the annuity can always withdraw at least a full account value. No, it's not true. It's true with fixed index annuities, and it's not even always. If you withdraw your money early, then there'll be surrender penalties, right? So let's say you put in 10,000 and there's a 10% surrender penalty, and you take out your money early. So now instead of getting 10,000, you're getting 9,000. No, you're getting $9,000, right? So no, it's not always. It depends on surrender charges. It depends whether it's a variable. So it's not always. So the correct answer here is B. The insured, the owner will receive a guaranteed minimum value if the contract is surrendered. So surrender, the non-forfeiture provisions are just there to say you get at least something minimum value, even if that's small. You get something small if your contract is surrendered.
I have the question, sir.
Yeah, sure. Go ahead.
Okay. So if you want to surrender, like I have a policy, if I want to surrender the policy, so the money that I've already contributed, I'm not getting it back.
No, you can get it back, but it may not be all the money. Because let's say the insurance company says, okay, we're going to charge you a 10% surrender value if you get your policy out in the first 1 year. So now let's say you put in $1,000 in the first 1 year, but you cancel your policy. So instead of getting 1,000, you get 900, right? So they'll subtract the so you get some minimum value. So the whole purpose of non-forfeiture
Forfeiture.
guarantee you to not lose all your money. So they want to protect the public. Where you should get, even if it's something small, get something small. Don't lose all your money when you decide to cancel your policy. That's what non-forfeiture means.
So all of those insurance things is a risk.
Of course.
Okay.
All right. So let's read the answer. You can read number 4. Read the answer for number 4, please. Okay, number 4.
Non-forfeiture provisions ensure the owner cannot lose everything. They guarantee a minimum value. Usually, premium pay less withdrawals plus interest, less charges. Sorry. This protection prevents total loss if surrenders. Option A and C exaggerate the rules.
So all they want is for you not to lose everything. So it protects, you have some minimum, where you can get something small. You don't lose everything you put in. So usually the premiums you pay minus any withdrawals, if you made any withdrawals in the past, plus interest, they'll always pay you interest. And if there's any charges, like maybe surrender charges, surrender fees, and all of that. All right. So thank you very much for watching. If you're watching this on YouTube or if you're listening on the podcast, thank you very much. We are doing something amazing here. Our pass rate is 98%. So 98% of our students pass their life insurance exam with flying colors. The national pass rate is 50%. Last year, 200,000 people failed their life insurance exam. And some of those people who failed, some of them studied for up to 2 months. Some of them have a master's degree. So they didn't fail because they didn't study hard enough. They didn't fail because they were dumb. No, they failed because they didn't know the system, right? They didn't follow the system. And to pass this life insurance exam, there's a system. The good news is we've cracked that code to pass your life insurance exam. As I said, our pass rate is 98%. We've helped students pass their life insurance, people who have even failed their exam up to 7 or 8 times. They've come to us, we've helped them pass. We've helped people as young as 18 years old pass their life insurance exam, people as old as 67 years old pass their life insurance exam, people from almost every single state, from Washington to New Jersey, New York, California, you name it, all across the United States of America. We have helped people pass their life insurance exam, and you will be our next success story. So if you don't want to fail your exam, like 200,000 people last year failed their life insurance exam, then book a one-on-one consultation. That consultation is free, or you could just click the link in the description and sign up for one of our membership programs or sign up for our self-study. Until next time, we wish you all the best on your life insurance exam, and we wish you a successful insurance career.